Welcome back to Deep Dive, where we unravel the world's most interesting stories in ways anyone can understand. Today, we're exploring a headline from Bloomberg titled "Yields on New China Dollar Bonds Fall Below Treasuries in Debut," written by Amaya Carvey, Finbar Flynn, and Loretta Chen. This story could have big implications for global finance, and we're here to break it down for you. So, let's start with a quick question. Have you ever lent money to someone? Imagine you lent your friend $10, and to make it worth your while, they promise to pay you back with a little extra, like 50 cents. That extra amount is called a yield or interest. The less extra they offer, the less appealing it might be to lend them money, right? But let's say everyone trusts this friend so much that they'd happily lend them money even with a very low return. That's sort of what's happening here with China's bonds. China recently sold something called dollar bonds. In simple terms, these are like IOUs that China issued in US dollars, promising to pay back the amount with a little extra, what we call the yield. Usually, the US is known for having some of the lowest yields around because people trust it to repay. But, in a surprising twist, China's bonds came in with an even lower yield than US bonds. Basically, people were eager to lend money to China, even if it meant they'd get less back in interest than if they lent it to the US now. That might sound odd at first. Why would anyone go for a lower return? That's because there's more to this story. There are a few reasons behind this high demand. First, think of it like this: China is becoming a very popular place for global investors. Just like how we diversify our favorite playlists, investors like to spread their money around for security. Right now, they see China as a stable option for investments, alongside the US, even if it means accepting a lower yield. Another reason is that a lot of these bonds are being bought by people in Asia and the Middle East, who may have different investment goals. Some of these countries are building strong financial ties with China, so buying Chinese bonds might make sense for their long-term relationships and goals. So, what does this mean for the US and the Western credit ratings we're used to? Normally, big Western companies rate countries on how safe they are to lend money to. The US has always been top-rated, which means low risk and reliable. China's rating isn't as high, but people are still jumping in to buy these bonds anyway. Some investors might feel that the traditional Western ratings don't fully capture the reality anymore. This shift might mean that investors are looking beyond just these ratings and forming their own views about what's safe and worthwhile. It's kind of like if movie critics gave a film low stars, but everyone still went to see it anyway. So, what could all this mean moving forward? This shift tells us that the world of money is getting less centralized. For a long time, US bonds were the world's favorite safe investment. But now, as China gains more attention, we might see a more balanced playing field. Countries around the world could feel less pressured to rely only on US financial influence. Instead, they might strengthen bonds, pun intended, with other countries like China. That could mean more diverse markets, more options for global investors, and potentially a new financial balance of power. So there you have it. China's dollar bonds are making waves, not just because of their low yields but because they're signaling a change in global finance. More investors are looking at China as a reliable place to put their money, and that's reshaping the investment landscape. If you enjoyed today's episode, remember to hit that subscribe button and share Deep Dive with your friends. And as always, we'd love to hear your thoughts. Why do you think people are so interested in Chinese bonds? Let us know in the comments or on social media. Thank you for listening to Deep Dive.